Hi, my name's Adam. Welcome to the channel. Thanks for joining us today. Today we're going to talk about liquidity and two parts to this. So whether you're leading up to retirement or already in retirement, this is going to cover both of you because I want to talk about how to build up your savings, your investment portfolio leading up to retirement so that you have efficient liquidity. And when I say liquidity, I don't necessarily mean you have cash ready to take out. It's more structuring of plans. How do you structure your portfolio so that you're in the most efficient spot when you hit retirement? And then I'm going to transition to when you're in retirement, how do you make sure that you have proper liquidity within those accounts as well? So we're going to cover both of those as we go through this video. So let's start off with building up to retirement. Now, there's kind of two buckets of clients, I always say. There's bucket one, which is people with a defined benefit pension plan. And that's a small bucket and it's becoming even smaller as time goes on. Now, if you're someone with a defined benefit pension plan, when you hit retirement, you'll probably have a very nice pension that's guaranteed, adjusted with inflation, and will probably provide for your lifestyle right through retirement. The issue with that is that you can't really create this like go-go phase, slow-go phase, no-go phase. If you have a big expense, where does that money come from? It's hard to kind of front end your retirement plan, your cash flow plan in retirement, because your money is kind of flatlined. It'll keep up with inflation, but you can't go to your pension plan provider and ask for a big lump sum because you want to go on a trip. So you need to make sure you're still building up assets outside of the defined benefit plan. And this is a mistake I see a lot of people make. What you need to do is start building up other accounts. Ideally, TFSA is number one. And if you are in a high tax bracket and your pension adjustment with your defined benefit plan, if there's still some room there and you're still in a high tax bracket, look to use an RRSP. So TFSA and RRSP are two accounts you should be building up. So when you get to retirement, you can use those accounts to draw down early to create more of that go-go phase and laddered income and create that flexibility in retirement. Again, when you hit retirement, you could have big expenditures. You could have replacing your roof or whatever it is. Where are you getting that big lump sum from? You want to think about that. For those of you that don't have a defined benefit plan, you may have a defined contribution plan where you put money in, but when you retire, that rolls into what's called a LIRA, locked-in registered account. And that has a lot of constraints on it. First off, it doesn't guarantee you an income for the rest of your life. You're in control of that asset, and you have to make sure that it works for you. So that's part one. But part two is that LIRA, when you start drawing income out of it, you convert it to a LIF, a life income fund. And depending on which provincial jurisdiction your LIF is from, or your LIRA is from, you may be unable to unlock. And when I say unlock a LIRA, it means moving 50% or up to 50%, sometimes it's 100, but it's moving an amount from the LIRA into an RRSP. It's not taking it cash into your hands, it's just moving it to an RRSP. Whatever is left in your LIRA that you cannot unlock goes to a LIF. And that basically has a minimum amount and a maximum amount that you can take out every single year. So it's very limited. So if the majority of your savings leading up to retirement is in a defined contribution plan, understand which jurisdiction you're in and if you're able to unlock any of that LIRA when you hit retirement. Like in BC where I am, you can't unlock any of a LIRA. So if I had a client retiring and they had 100% of their retirement savings was in a LIRA, it's very limited. It's like a defined benefit pension plan, but they're in control of the asset, which brings on more risk. Where I'm going with this is you have cash flow restraints. So you need to make sure that you build up RRSP, TFSA accounts outside of that LIRA account or the defined contribution account to give you that same flexibility. Defined benefit, defined contribution, understand that there's very little flexibility when you get into retirement unless you work to build up other accounts to create that flexibility within. And for those of you that don't have defined benefit or defined contribution plan, maybe you don't even have a matching plan at work, you're just building your own RRSP and building your own asset base, and that's great. And that's probably the majority of you watching this video. If that's you, you need to make sure that you're utilizing RRSP and TFSA. Those are the two primary accounts you're going to use. Now, as a general rule, and this is a very general rule, I would say if your income's over 50,000, look to use an RRSP. If it's under 50, TFSA. Now, if your income's over 50 and you're utilizing an RRSP, one thing that a lot of people kind of forget about or don't use is that TFSA. You still want to utilize a TFSA. So one thing I always encourage or challenge people to do is save as much as you can into the RRSP every year. If you're saving into your own RRSP, you're getting after-tax money, you're putting that into the RRSP, and at tax time, that should generate a tax refund for you. Take that tax refund and put it into your tax-free savings account. That's the easiest way to start going on the RRSP TFSA saving, like how to save for both. Save into RRSP, whatever your tax refund is, lump it into your TFSA. And trust me, if you start doing that at a young age and keep building that up, when you hit retirement, you're going to have a nice balance between the two. The RRSP is going to give nice income. That's going to be, a primary income earner for you in retirement. You're going to have CPP and OAS eventually, but that RRSP is going to be your big account. That's typically the largest investment account you have when you hit retirement. But that TFSA account, the tax-free savings account, that's going to be the account that lets you have flexibility. It's going to give you that tax-free income. Remember, you can pull money out of that on a tax-free basis. So when you hit retirement, again, when you want that go-go phase, where do you get that extra money from without driving up your tax rates? Probably your TFSA account. Now, on the high side of things, a lot of you have reached out and said, look, Adam, I've maxed out my RSP, I've maxed out my TFSA, what do I do now? And typically it's a non-registered account. Depending on what age and stage of life you are, if you're younger, you could look at, and this is a bit of my own personal strategy that I do, is once I've maxed out my RSP and my TFSA, I actually look to upgrade my principal residence. This is kind of a unique one, and definitely, talk to your financial advisor before you do anything like this, but I upgrade my principal residence because I can grow that on a tax-free basis. So I look at my principal residence as another TFSA account that's tied to real estate. But for the majority, 99% of you, once you've maxed out your TFSA and RSP, look to utilize a non-registered account. Now, there's a lot when it comes in. I'm not going to cover it in this video, but if you have a TFSA, an RSP, and a non-registered account, you need to be aware how you invest these, okay? Because what happens is that non-registered account, the income that you generate on there is taxed every year. So hopefully, if you're married to common law, create a joint account so you can split that income, but it's taxed every year. So if you're a balanced investor and you need some bonds and some equities within your portfolio, ideally you want to own the bonds in your RSP and the equities in your non-registered account because it's not generating interest income. So there's some tax planning and tax efficiency. So make sure you talk to your financial advisor about this. Now, again, if you have an RSP, a TFSA, and a non-registered account, and you look at your statements and you're in the same mutual fund in all three, that's bad advice. You want to talk to your advisor and make some changes there. That's just not proper planning, not proper tax planning as you lead up to retirement and even in retirement. You want to kind of rejig that to make sure that you're building your portfolios from a tax efficient manner. As you put money in RSP, TFSA, there's tax planning there, right? You're getting a tax refund or you're growing money on a tax-free basis. But even within the accounts, how you invest them, how they grow for you, that's tax planning as well. A lot of clients will say, okay, Adam, where's the tax planning in my plan? And a lot of it is just how much you put here, how much you put here, how you invest it within. That can save hundreds of thousands of dollars in tax leading up to and through retirement. Now, if we gear into retirement now, when you switch into retirement, there's a few things that we've bumped up against with clients that I hadn't seen in a long time. And it keeps coming up. And that is investments in products or solutions that are locked in. So it could be a GIC. And again, I talked about this not too long ago on this channel where a GIC at EQ Bank right now and others, 4.3% on a 1-year GIC. That's pretty good rate. So if you're kind of concerned about what the market's going to do in the next year, it could be a good option. But before you lump money into a GIC, whether it's a 1 year or longer, what's your cash flow need? And a lot of you are locking into GICs, limited partnerships, mortgage trusts that you can't get out of for long term. There's these different investments that require you to stay invested for a certain period of time. And a lot of you are doing that right before or even early in retirement. And you're not looking at your cash flow plan and you're kind of stubbing yourself in the foot. Because what's happening is your cash flow plan says you should be taking some out or at least deregistering some money, and you can't because you're locked into something. So make sure you understand your cash flow plan, where that cash flow is coming from, how much you need, whether you need it or not, right? A cash flow plan is not an income plan. A cash flow plan for taxes in retirement is pulling money out. So it might be, we need to deregister 50,000 from your RIF this year. It doesn't necessarily mean you need the 50,000. We might be moving it to a tax-free or non-registered account. But for tax planning, we need to kind of shuffle it out. If you're in a limited partnership or locked into a GIC or something like that, it may limit you from doing that. So understand the plan, the cash flow, the tax plan, get that in place first, and then sort out your investments after that. A lot of you do investments and then gear down to the plan. What you need to do is the plan and gear down to the investments. Besides that, the plan will also tell you, here's how much rate of return. So if you average 5% net of fees, here's what your income in retirement looks like. You can stress test it at 2-3% or at 6-7%. You can go either way. But that's going to give you kind of that peace of mind saying, at 5%, I'm easily hitting my cash flow in retirement. I don't need to take as much risk. Or I don't hit my cash flow. I need to get that 6 or 7. I need to take more risk. Maybe I need to lock into something to get that. But again, understand that cash flow. So as you gear up for retirement, make sure that you're saving in different buckets. Again, if you're one of these people with a defined benefit plan, don't treat that as the only retirement income for retirement. It's going to hurt you. We had some clients that did that. We had to do kind of a reverse mortgage thing, create some flex. It was really messy. It's possible with really intricate planning, but it's not a great situation to be in. You'll start saving, build up an RSP, invest in RSP, take the refund, put it in your TFSA. That's the easiest way to get started. This is whether you're 25 or 55. These are strategies that work no matter what your age is. Start saving. A lot of you, especially as you get closer to retirement, your mortgage is gone. If you had kids, they're out of the house now. You have a lot of free cash flow. Start utilizing. You probably have a lot of RSP contribution room that you haven't used. Pound away at your RSP. You're going to get a really nice tax refund. You can top up your TFSA. Trust me, when you get to retirement, you will look back on this video and thank me. You're going to spend more early in retirement. And if you haven't planned your accounts for retirement, you're not going to kind of be able to build that laddered income in retirement. So thanks for joining us in this video. Hopefully this information helped you. Hopefully it kind of helps you kind of rejig your investment plan within your portfolios, where you're saving, how you're putting money, how you're building that for retirement. And again, if you're in retirement, be aware of how and where you're investing. Don't lock your money into something that's going to cost you kind of tax money down the road or tax planning money. Make sure it's free to pull out when you need it. So thanks for joining us in this video. We'll see you in the next one.